If you're new to the mortgage world, you've probably heard people talk about underwriting like it's some kind of mysterious black box. Well, today, we're going to pry that box right open. We're breaking the whole process down into 4 simple, essential pillars.
So, what is going on when a loan file lands on an underwriter's desk? Is it just some random decision-making process? Absolutely not. It's actually a very methodical, very structured way of looking at risk.
And that whole process really just comes down to what we call the 4 pillars. I want you to think of them like the legs on a table. If even one of those legs is wobbly, the whole thing is unstable. The underwriter's job? It's to test the strength of every single one.
All right, so here's our game plan for this explainer. First, we'll crack the underwriting code and get inside the underwriter's head. Then, we're going to dive deep into each of those 4 pillars: the borrower, the income, the debt, and of course, the property itself. And finally, we'll see how it all comes together to build a strong story for getting that loan approved.
Okay, first things first, let's talk about the underwriting mindset. Their job isn't just to go down a checklist. It's really about assessing risk by asking some really basic, fundamental questions for every single loan they look at.
Now, this is a huge point, so I really want you to get this. An underwriter is not a gatekeeper who's just looking for a reason to say no. Think of them more like a detective. They are piecing together all the evidence to build a logical, solid case for why this loan makes sense and should be approved.
And that leads us perfectly into our very first pillar, the borrower. This is all about the person's financial character. What is their track record? Do they have a solid history of paying their bills on time?
One of the biggest metrics here, as you probably know, is the credit score. For a standard conventional loan, 620 is a really common minimum score. You can think of it as kind of the price of admission. It's a number that gives a quick snapshot of the borrower's reliability with handling debt.
But, and this is key, that number is not a universal rule. It really shows you how different loan programs think about risk. So while a conventional loan often needs that 620, an FHA loan might go as low as 580, or heck, even 500 if the borrower can put 10% down. The guidelines really adapt based on the loan product.
Okay, let's shift gears to our second pillar, income. This is all about capacity. It's not just about the dollar amount someone makes. It's about how stable, how reliable, and how likely that income is to continue for at least the next 3 years. That's the magic window they look at.
And when we talk about income, we have to talk about this key industry term, grossing up. See, an underwriter can't just compare someone's taxed W-2 income with someone else's non-taxable Social Security income. It's not apples to apples. So grossing up is how we level the playing field, making it a fair comparison.
It's actually a really simple process. First, you just take the verified non-taxable income. Then you multiply it by a factor, usually somewhere between 115 and 125%. And boom, that gives you the qualifying income amount. It's all about getting a true picture of their ability to pay.
So, income is obviously huge, but it's only half the story. Pillar number 3 is all about the other side of that coin, debt. Here, an underwriter is looking at everything a borrower owes each month: car loans, credit cards, student loans, the whole shebang.
The big question is, how do these two sides, income and debt, balance each other out? And we measure that with the debt-to-income ratio, or DTI. It's a simple percentage. You take all the monthly debt, add in the new house payment, and then divide that by their gross monthly income. I'm telling you, this is one of the most important numbers in the entire file. But what if that DTI is too high? Well, it's not always game over. There are often some pretty quick fixes. Paying off a small personal loan can make a massive difference. Adding a co-borrower can bring in more income. Oh, and here's a good one. If your borrower co-signed a loan for someone else, if you can prove that other person made the last 12 payments, you can often get that debt completely excluded.
And that brings us to our fourth and final pillar, the property. So far, everything's been about the borrower. Now the underwriter completely shifts focus to the house itself. Is this a good investment? Is it safe, sound, and good collateral for this big loan?
And just like with credit scores, different loan programs have different standards for the house's condition. For a conventional loan, the appraiser gives a rating from C1, which is great, all the way down to C6, which means it's in rough shape. Freddie Mac, for example, says C5 and C6 properties are a no-go. FHA has a similar scale, but the VA has its own unique rules called minimum property requirements, or MPRs.
So we've got our 4 pillars: the borrower's credit, their income, their debt, and the property.
The final piece of the puzzle is seeing how they all fit together to tell that approval story.
A good underwriter connects all these dots into a story that makes sense. A strong loan file isn't just about a great credit score. Maybe a borrower scores just okay, but that's balanced out by really high income and tons of cash in the bank. It's all about how these four pillars support each other.
I love this quote because it sums it up perfectly. The pay stubs, the bank statements, the appraisal report, those are just chapters. A truly skilled team assembles them into a complete financial story, one that clearly shows why lending this money is a low-risk, logical decision.
And that wraps up our deep dive. But before you go, I want to leave you with a question to think about. In today's market, with everything going on, which of these four pillars, borrower, income, debt, or property, do you think is the single biggest hurdle for home buyers right now? I'd love to know what you think. Thanks for watching.